Ever feel like prices just keep climbing and never drop? Have you ever noticed how some prices, like your grocery bill or your rent, just seem to go up and never come back down? Even when the news says inflation is cooling, your wallet doesn't feel it. It's like prices are stuck in high gear. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we re-unpacking one of the biggest economic mysteries of the post-COVID era: sticky inflation. This is the stubborn phenomenon where prices and inflation rates don't fall quickly. Even after the economic pressures that pushed them up have eased. Think about it. Energy prices can drop fast when oil gets cheaper. Those are flexible. But the cost of a haircut, your car insurance, or a meal at your favorite restaurant often stays high. Those prices are sticky. For a long time, experts told us that the inflation spike after the pandemic was transitory. They believed that once supply chains healed and life returned to normal, prices would snap back. But they were wrong. The global economy underwent deep structural shifts in labor markets, production, and how we all spend our money. This brings us to the core question we answer today. Why Haven? Tea prices come down, and could we be entering a new era of permanently higher costs? To understand where we are, we have to look at how we got here. The post-COVID inflation surge was a perfect storm. As the pandemic shut down the world, governments unleashed trillions of dollars in stimulus to keep economies afloat. At the same time, global supply chains, the intricate web that moves goods around the planet, completely broke down. Then, as lockdowns lifted, consumers burst back onto the scene with a vengeance. Flush with cash and tired of being cooped up, we unleashed a wave of pent-up demand for everything from cars and furniture to travel and dining out. But the supply side couldn't keep up. We saw massive supply-side shocks. Container shortages sent shipping costs soaring, ports were clogged with delays, and a scarcity of key components like semiconductors brought factories to a halt. Simultaneously, demand-side forces were pouring fuel on the fire. Trillions in fiscal aid and near-zero interest rates made borrowing cheap and spending easy. Faced with surging demand and rising costs, firms did what you'd expect. They raised prices. But here, as the crucial part, even when their own costs for shipping or raw materials started to normalize, many companies didn't lower their prices. This is where we see the concept of margin stickiness. Businesses protecting their profit margins, which became a key driver of persistent inflation. So, why do these prices stay stubbornly high? This isn't just about corporate greed. It's rooted in several core economic mechanisms that create price stickiness. First, there are menu costs. This is a classic economic idea. For a business, changing prices isn't free. Think of a restaurant having to reprint all its menus, or a retail store having to update its online catalog and retrain its staff on new pricing. These logistical and administrative hurdles make businesses hesitant to change prices frequently, especially downwards. Second is a strategy called cost-plus pricing. Many firms don't constantly reevaluate their prices based on market demand. Instead, they calculate their cost of production and add a standard markup or margin. When their input costs fall, they often choose to enjoy a temporarily wider profit margin rather than passing the savings on to consumers immediately. They might anticipate future cost increases or simply want to protect their bottom line. A third and hugely important factor is wage stickiness. During the post-pandemic recovery, we saw widespread labor shortages. The Great Resignation empowered workers, who demanded and received higher wages. These wage gains are notoriously sticky. Unlike the price of oil, wages rarely go down. Companies that are now paying their staff more are reluctant to cut prices because their labor costs remain elevated, and they need to cover that expense. Fourth, we have inflation expectations. This is where psychology comes into play. Once businesses and consumers start to believe that inflation is going to stick around, it becomes a self-fulfilling prophecy. Workers demand higher wages to keep up with the rising cost of living, and businesses raise prices in anticipation of higher costs in the future. This cycle is hard to break. Finally, we saw supply constraints and nonlinear responses. In normal times, a small increase in demand might cause a small price bump, but when supply chains are already stretched to their limit, as they were post-COVID, even a small additional increase in demand can cause a disproportionately large jump in prices. And once prices jump, they are slow to come back down. This isn't just a theoretical problem. We're seeing real-world evidence of sticky inflation across major economies. In the United States, inflation remained high long after the initial supply chain snarls were resolved. Federal Reserve reports have highlighted a fundamental shift in how firms set prices, with many becoming more willing to pass on costs and less willing to cut prices later. Short-term inflation expectations among consumers also shot up and have been slow to decline. Over in the United Kingdom, the story has been one of stubbornly high service inflation. While goods inflation has cooled, the cost of services, things like hospitality, insurance, and transport has remained elevated, creating a unique and difficult challenge for the Bank of England. Canada and Australia have faced a similar dilemma. Rising wages, relentless pressure in the housing market, and slow disinflation in the service sector have kept their central banks on high alert. Interestingly, some countries like Japan and those in the Eurozone saw a slower and less persistent rise in inflation. Why? Institutional differences played a big role. For example, some European countries have more centralized wage bargaining systems, which can prevent the kind of rapid wage price spiral seen elsewhere. The timing and scale of their policy responses also differed, leading to different outcomes. Faced with this persistent threat, what are policymakers doing? The standard response from central banks around the world has been to hike interest rates aggressively. The logic is simple. By making it more expensive to borrow money, they aim to cool down spending, reduce demand, and give supply a chance to catch up, thereby easing pressure on prices. But here's the challenge. With sticky inflation, this traditional monetary policy takes much longer to work. The effects of interest rate hikes can take 12 to 18 months to fully filter through the economy. In the meantime, there's a serious danger of over-tightening. If central banks raise rates too high for too long, they could choke off economic growth and trigger a recession before inflation has fully returned to their target. To combat this, central banks are also heavily relying on forward guidance and communication clearly stating their intentions to help manage public expectations and prevent inflation psychology from becoming entrenched. So, where do we go from here? Economists have mapped out a few possible scenarios. The base case scenario is a process of slow, grinding disinflation. Inflation gradually declines over the next year or two, but settles at a level that is still above the 2% target that we were used to before the pandemic. But there are also risks. An upside risk scenario involves new shocks. Another major geopolitical conflict, new trade restrictions, or a spike in energy prices could easily reignite inflation and force central banks to tighten policy even further. On the other hand, there's a downside risk. Demand could collapse more quickly than expected, or the delayed effects of past rate hikes could bite harder, sparking a recession. And then there's the worst-case scenario, a period of stagflation, the toxic mix of high inflation and low economic growth that plagued economies in the 1970s. This macroeconomic debate has very real implications for all of us. For consumers, sticky inflation means the continued strain of higher costs for groceries, rent, and essential services, eroding purchasing power and making it harder for households to save. For businesses, it creates a strategic dilemma. Do they cut prices to try and gain market share, or do they maintain their higher margins at the risk of losing customers? This decision is shaping competitive landscapes across industries. For investors, this new environment requires a different playbook. Assets that provide a hedge against inflation, like real estate, commodities, and certain types of stocks, become more attractive. The era of easy returns fueled by low interest rates is over. And for governments, sticky inflation means heavier debt burdens. As interest payments on national debt rise, it also creates immense public pressure to provide relief, a difficult balancing act when fiscal spending can itself fuel more inflation. As we look forward, it's time to reflect on the lessons learned. The biggest takeaway is that the era of low inflation forever is likely over. For decades, we took stable, low prices for granted. The post-COVID world has shown us that inflation can return and persist longer than anyone expected. Our institutions, from central banks to governments, must adapt to this new reality. Policies that improve productivity and build more resilient supply chains will be crucial in helping to reduce price stickiness in the long run. The ultimate key will be anchoring inflation expectations and preventing the psychology of high inflation from becoming the new norm. This brings us to a final thought-provoking question. Are we ready for a world where 3 to 4% inflation is the new normal? If you found this breakdown helpful, drop your thoughts below. Don't forget to subscribe for weekly deep dives on global economics.